Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, October 16th. The Dutch chip equipment maker ASML, well, they accidentally announced their quarterly results a day earlier than expected yesterday, and their results were rather disappointing. Then Louis Vuitton's LVMH results after the bell didn't help investor mood either. In the US, advanced chip makers were left in the crossfires again. Happily, the big US banks' results were good enough to lift the mood and to provide some cushion. So yesterday could have been a calm session in Europe, with most people actually waiting to see whether the stimulus measures that were announced in China back in the end of September would have miraculously shown in the third quarter results of the luxury item makers like LVMH, for example, which was due to report its third quarter earnings after the bell yesterday. And I will spoil this, but no, the Chinese didn't rush to pop the champagne and to buy Vuitton bags as soon as they heard that China would be cutting the interest rates, the mortgage rates, and other rates, among other measures, to reverse the fortunes of the country. So the earnings season isn't looking too promising for the European luxury makers, to say the least. So that's one thing. But coming back to why Europe was shaken yesterday, well, it's because ASML, which is Europe's biggest company by valuation, revealed its results a day earlier by accident, and the results were not good at all. ASML actually booked about half of the orders penciled in by analysts last quarter, as demand for chips outside AI continued to struggle. So here we are talking about slower demand for memory chips, for example, slower demand from car makers and several industries around the world where customers are actually cutting back orders because, well, simply because they do have enough inventory of chips in their hands and not enough demand for their products. And don't be surprised by it because, well, companies like Intel, Samsung and SK Hynix, for example, have been ringing the alarm bell lately as well that the recovery in the chip space is not on a solid footage. Now, more bad news, ASML also cut its 2025 forecast, and more details are to come as the company wasn't supposed to release its quarterly earnings yesterday. But it is obviously needless to say that ASML shares plunged 16% at yesterday's trading session, the most in 26 years, and the company stands for about 8.5% of the STOXX 50. So the STOXX 50 tumbled nearly 1.90% yesterday, and the company also stands for about 3% of the STOXX 600 index, and so the STOXX 600 index fell by about 0.8% at yesterday's trading session. And across the pond, the AI chip makers didn't have a good session either, but for completely different reasons. Because the US announced yesterday that it will restrict the advanced chip exports from companies like Nvidia and AMD toward countries that do have connections to Gulf countries in the Middle East for national security reasons, as war in the Middle East is taking an uglier turn by the day. And well, as you know, the Gulf countries are thirsty for AI, and they also have deep pockets. So the news, well, resonated quite loudly and not too well across the chip makers yesterday. Nvidia died more than 4.5% from a near record level. AMD dropped more than 5%, and VanEck Semiconductor ETF took a 5% dive as well. And all that sell-off obviously weighted heavily on Nasdaq 100 index, which gave back 1.37% yesterday, as the S&P 500 retreated 0.76% as big banks in the US that were due to announce their third quarter results announced better than expected earnings. Now, quickly, there are a lot of things to look at in these bank earnings, but if you concentrate on the global headlines, the headline news was that Goldman's revenue jumped 45% in the third quarter on surprise gain in stock trading revenue. Then Citigroup and Bank of America's profits dipped less than expected by analysts. So all in all, the US big banks have done better than expected last quarter. And SPDR's financial sector fund advanced to a fresh record, and Morgan Stanley will report its own earnings tomorrow as well. So voila. Elsewhere, well, crude oil sold off yesterday, and it sold off heavily for the second consecutive session on, well, relief that Israel is planning to hit Iran's military rather than its energy and oil structure. So the barrel of US crude tipped a toe below the $70 per barrel level yesterday and rebounded to close the session with a 2% loss only. The US crude trades a touch below the $71 per barrel this morning. At the time I'm talking here, the MACD index on the daily chart just turned negative, supporting the idea that crude oil is now back to its bearish trend that's building since summer, and resistance is seen near the $72 per barrel level, which is the major 38.2% Fibonacci retracement on that summer retreat. The Chinese struggle, obviously, and deteriorating global demand outlook for oil are the major catalysts of the moment for potentially deeper losses in crude oil prices. So a move below the $70 per barrel level should pave the way toward the $65 to $67 per barrel range in US crude. Now, speaking of energy, Microsoft has announced a few weeks earlier, remember, that it would team up with Constellation Energy to bring some nuclear reactors in the 3 Mile Island back to life to, well, satisfy its growing thirst for energy, as AI is very, very energy intensive. Then yesterday, Google announced something similar. They announced that they're investing in the development of next generation nuclear power by backing a company that's building small modular reactors, from which, well, Google will be buying energy when these sites start supplying energy toward the US grids. Now, capital inflows into the nuclear energy have been stagnating for the past decade, but they started gaining momentum since the war in Ukraine started and raised the urge of a rapid transition toward alternative energy sources that solar and wind energy powers alone can't satisfy, as our energy demands are obviously rising very, very rapidly with AI. So the investment world is now turning toward the nuclear option. They're less skeptical, and VanEck uranium and nuclear ETF is up by 73% since the war in Ukraine started, and up by 62% since the beginning of 2023, when ChatGPT joined our lives and make the big bang for AI. And the nuclear outlook is clearly positive and getting increasingly positive by the day. In the FX, the US dollar index consolidated gains yesterday near its 100-day moving average level and halfway on the summer sell-off that we saw in the US dollar. Then the euro dollar extended its losses. The pair is now consolidating below the 109 mark this morning, as the euro bears are eyeing a further retreat toward to or below the 200-day moving average that stands near the 108.75 level. The ECB meets tomorrow, and the bank is expected to announce another 25 base point cut when it meets tomorrow. Now, headline inflation in the Eurozone lately dipped below the 2% policy target, and while European economies are struggling, as you know, with Germany thought to be in a mild recession right now. Now, the only thing that could eventually hold the European Central Bank officials back from a dovish cut tomorrow would be the sticky core and services inflation. So if that's the case, we will still have a cut in Europe, but it would be a hawkish one. But overall, given the deteriorating fundamentals of the Eurozone, compared with the resilience of the US economy, well, the single currency could and should lose more ground against the greenback from the actual levels. And speaking of inflation and Europe, inflation in Britain not only fell below the 2% mark in September, but came in significantly lower than expected. So at 1.7% year on year versus 1.9% expected by analysts. And although core inflation remains sticky near 3.2% level, that number also surprised to the downside this morning. So British inflation's downward trajectory, combined with slowing wages growth that was announced yesterday, emphasizes the Bank of England Governor Mr. Andrew Bailey's latest comments that the Bank of England will get more aggressive on its interest rate policy. So that meaningful dovish shift in the BOE's language, backed by the soft inflation data, will likely send cable back below the 1.30 level in the coming days or in the coming weeks. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.